There are different risks to be considered when building a fixed income portfolio. Credit risk is the risk that a company cannot repay its debts. Most companies are under ASX supervision or ratings agency supervision. A ratings agency advises investors as to the credit worthiness of an organisation. Liquidity risk is the time in which you need to find a buyer and seller in a moment of heightened activity in the market, so heightened volatility. The liquidity risk around capital structure becomes very important. The further you up the capital structure, the safer your asset is, the more likely there'll be a buyer or a seller at a liquid time or at a volatile time. When you deal in the bond market, you get paid T+3. What that means is after 3 days, the money will be in your account. So therefore, the higher you are up the capital structure, the safer the assets are, and the more likely you'll have liquidity in challenging times. Inflation risks are where the price of goods and services accelerate and reduce your purchasing power. The only hedge against inflation is an inflation-linked bond. This is a bond that is linked to inflation, so the performance over time means if inflation goes up, the value of your bond will increase and you'll get a better return. We believe that all investors should have as part of their portfolio an inflation-linked bond. Interest rate risks are the movements in interest rates, so the cash rates, that adversely affect an investor. We ask all investors to consider an array of different interest rate products in their portfolio. So if you bought a fixed rate return with interest rates going down, your bond will be more valuable. If interest rates go up on a fixed rate bond, it loses its value. Therefore, we ask you to buy a floating rate bond. So if interest rates go up, the floating rate bond becomes more valuable, and conversely, when interest rates go down, that floating rate note loses some of its value, some of its attractiveness. If you buy both those bonds, you've mitigated against that interest rate movement. There's an array of bonds that are issued in the market, and some of those bonds will have a call date, they'll have a maturity date. It's the first opportunity for the issuer to redeem the bonds at $100. The call risk is the risk that the issuer doesn't redeem and extends the maturity of the bond. In the event he did that, or she did that, the bond would decrease in value, because the market convention at this point in time is that the first opportunity for a bond to be redeemed will be redeemed at the call date.